welcome back. And it has been a while since I previously recorded. I believe we were working on the valuation of options, and we looked at the first way of valuing options, which is sort of like binomial. All right, so let's look at what we have covered so far. So if we go back, so let's look at the first slide. Introduction to derivatives. This is what we covered: types of derivatives, value of a derivative, then the markets for derivatives, mechanics of derivatives. Then we jumped to the determination of forward and future prices, and we also looked at the binomial, right? Now in this particular video we'll be looking at the Black-Scholes calculation and how important it is, and what are the nitty-gritties and the caveats of the Black-Scholes valuation, and also how it was developed, how different pieces of the formula works, and the assumptions, the limitations, and also we will be doing a real world valuation exercise of options using the Black-Scholes model. All right, with this agenda in mind, let's move forward. Let's look at what is Black-Scholes. And so basically, Fisher Black and Myron Scholes, they published a piece of paper in 1973, and that was way back, like it's almost 50 years ago that they published this paper called Pricing of Options and Corporate Liabilities. But then that paper was having some problems, or maybe it had some limitations, which was further developed by Robert C. Merton, and that's how we get this term as the BSM model, which is the Black-Scholes and Merton model. So later on, when the theory of rational option pricing was developed by Merton, it was the more usable, or it became more practical. In the sense that it was now the traders or the hedgers at that point of time had something to value an option, and they don't have to rely on their instincts for the pricing movements, and they had something for the first time in the history of mankind. And then they went ahead and created a company called Long-Term Asset Management, something like that, in 97, which failed dramatically. I mean, you should go back and read this history. They raised a lot of money. The company LTCM, I believe, raised a lot of money, and it went bankrupt at some point, and because of the flaws in the limitations of the Black-Scholes models, which we will cover in the series. So this particular model was a success, so to speak, and one of the important things why the Black-Scholes model was used is for delta hedging. And delta hedging, as I will explain you, it helps traders to hedge their position and be confident that the money which is on the table is not going to go away. If the stock price goes up, or if it goes down, particularly, the money is not lost, right? So this is one of the applications or the key applications of Black-Scholes and BSM model. I would say it as BSM model. However, one of the things which I have seen in the industry in India is it is also used for calculating the implied volatility, and the IV is an important part. We will come to it later on. However, the pricing of the options, which is so it is re-engineered here in a way that the current price of the option is used to look at the IVs, or the implied volatility. So in the formula for options, what you can do is you can make some changes in the inputs and the output. And as an input, if you put in the current option price, which is currently priced by the market, which includes all the factors, supposedly you will get the implied volatility. So that is one further application of the Black-Scholes which I've seen in India. All right, so I will jump right into the delta hedging part of it, because it is an interesting thing, and this is one of the basic reasons why we have started trading in options. But now the speculative business in the world in options is so much that people have forgotten the initial use or why it was initially developed, right? Delta hedging is nothing but hedging the value of your underlying asset based upon the price movements, right? So there's a correlation observed between the options price and the asset price. And when I say asset price, I would typically refer to stock, because you'll be able to relate more with stock when I say stock, right? And not an underlying. Underlying asset is a better term to use here, but I would just stick to stock so that it's easy to understand, right? Now, with respect to this, with respect to the delta hedging, the option price and the asset price is having a correlation. So for example, if the asset price goes up, the value of a call option, as you all know, will go up, because at some point, if you bought a call option with a strike price of $100, and if the stock price goes up to $120, you have the ability to buy the same stock at $100 and then sell it at $120, thereby reap the profit. So if you have that option to buy it at $100, the automatically the in the money value of that option goes to $20, and if it is trading in the market, then the market will actually give its premium to the option, and it is going to be more than whatever in the money part it is having currently, right? So that's a part that is a different thing to discuss. But that said, the point I'm trying to make here is there's a positive correlation between the stock option and the call option and the stock price, right? And in the same way, there's a negative correlation between the stock price and the put option. So for example, if the put option, if the stock price is going up, the put option is always going to go down, because when a person buys a put option, the person thinks that or foresees that the stock price is going to go down. However, if in case the stock price goes up, then the put option is essentially worthless, right? So that is one negative delta stuff. However, typically the traders or the merchants used to maintain this delta part, so that they don't have to worry about the loss of value at a later stage. To maintain a delta of 0, now when I say stock price goes up, the option price goes up, so there's a positive correlation, and typically let's just assume that the delta is 1. So for example, if the stock price goes up, the option price or the call option price will go up by $1. So so it just means that there's a correlation of 1. So delta is nothing but a difference between the price of the option and the stock. So to maintain a 0 delta, you need to buy put option with the stocks you are holding, right? So I will explain you this by an example, and let's look at that example now. So let's say that we have 1,000 shares, or maybe let's say whatever, 1,500 shares of a particular stock, and 1,500 shares of stock A. Okay, and let's just say that there is a delta of 1, right? So if the stock goes up, that's fine, that's just fine. And by the way, you have these number of shares because you foresee that this is going to go up in the long term. So so you assume that stock A is going to go up in the long term, okay, in the long term. Now, however, in the medium term, in the immediate term, let's say immediate term, when I say immediate, I mean to say 3 months or 4 months down the line, immediate term, the stock goes down, okay? In this case, if now this is a long-term stuff, this particular sentence is long-term stuff and you don't have to worry about it. However, if this happens, like if it goes down immediately, like in the immediate term, let's say in 3-4 months, you need to do something to actually make sure that the stock stays at or the value stays where it is, right? So for example, if today the stock is valued at $1, $1, the value is number of shares, price, value is this times this, okay? And however, in the coming future, if it goes by, let's say, if it goes down by 0.25, so it would just be 0.75, and the value would go down by 0.125, whatever, right? So earlier the value was this much, now it has gone down by 25%. Now you need to do something to just make sure that you have this value in place, and that's all delta hedging is. Okay, so the value of the stock price, if it goes down, you need to make sure that the earlier value, which was 1500, stays the same. So in this case, what you're going to do is, now since you know that there's something called a put option, and you also know that let's say, yeah, you also know that if the stock price goes down, right, the value of the put option will go up. Okay, so if you bought some put options, let's say from the beginning, while you had shares, we just made sure that, you know, if the value goes down tomorrow, you know, because of the put option, I'm gonna reap the benefits and the value will still remain the same, right? So now how many put options to buy, and you know what needs to be done, is what we're going to be looking at first in here now. But the funda is, or the inherent logic is, that you need to buy put options as well, in case you want to hedge the deterioration of the value of the stock price, or the deterioration of the overall value of the stocks you held at day one, right? And this is what we'll be doing now. So let's just say there's a negative correlation in the put option, as we already know, and the correlation is not 1, and it is minus 0.25. Minus is just to signify the negativity between the put option and the value of the shares. So in this case, what will happen is, for example, if you bought 15 lot or 15 put options, let's just say, and we're assuming that a lot is having 100 shares. If the value goes down later on, what's going to happen is you will end up having this much, you know, value of the put option. So in this case, what's going to happen is, since the put option has a negative correlation, if the value of the stock goes down further, the value of the put option will go up. So in this case, if the value of the stock goes down by, you know, whatever number, and since you know at day one that the correlation is this much, you know, it doesn't matter, and the value is going to go up by 375. So you know, here it sees negative, but you know, just to make you understand, this negative value is going to be actually positive. So you will actually be making money if the value of the option if the value of the shares goes down, right? So in this case, what you did is you bought 15 put options, or I will just say 15 lot of put options. A lot had 100 shares, right? So you bought 15 lot of put options at day 1, when you know that the correlation, or the delta correlation, or delta is negative 0.25. okay, and this is established at day 1. Now here you took a position of 15 lots, and you're just sitting there now, right? So once the stock option once the stock price goes down, what's going to happen is the value of the put option will go up, right? And how much it will go up, it will all depend upon this factor, which is the correlation factor, right? Or which is the delta, right? And if it goes down by 0.25%, you're going to make $375, right? So in the interim, what happened is the value of the shares fell down, and you lost money here. So if you look at the difference here, if you look at the diff here, earlier your shares were valued at $1,500. Now it is valued at $1,125, $1,125. However, since you bought put options, you have actually made $375, and as a result, your put option is valued at what? Put option is valued at $375, and those stocks or shares are valued at what? Your shares are valued at $125, and this sort of like gives you what? This gives you $1,500. So if you see here, you're equal. After 3 months you still have the same value, right? And that is what delta hedging is basically. Okay, so I hope you have understood this. Now let's jump back to the slides and see the other assumptions of the model. All right, now let's look at the assumptions here. So the assumptions are fairly simple. Who invented this formula or who worked on this piece of paper, they had very simple sets of assumptions at their head, which is actually not applicable to the markets at large, right? And that's the reason why the formula per se has been modified over a period of time, right? So the assumptions were like, there's no dividend paying stock, which is not actually practical in the real world. Every stock pays dividends, right? Then the price movements are random, which is a fair assumption. Then no transaction costs. No transaction costs means there's no brokerage, there's no cost to buy a hedge, there's no cost to buy a risk-free asset like a GSEC security or a bond, and which is not really the case in the real world. And then the underlying stocks volatility is known, which is again a very big assumption, because in the current world, in the current scenario, if you see, the volatility is basically calculated out of the price. So we have re-engineered the formula. However, when they were putting this piece together initially, they were working on the assumption that the volatility is known, and which is not really the case. So I mean, as you can see, these assumptions will help you understand this from a theoretical standpoint of view. But if you look at these assumptions and if you go to the market, you're going to lose money and that's going to happen, right? So you need to actually understand how to work out the formula, so to value the options given current scenario, and that's the key takeaway. From a theoretical standpoint, it is actually good. You can read this, make your notes and sit in the exam and you're through. But then if you go to the real world, this is not going to help you. The only thing which is going to help you is to understand how the model really works and what changes were made over time, and how we have tweaked the formula, so to speak, right? And that's what is going to come in the next session, which I'm going to take. So I'm going to keep it very short so that it's easy for you to follow the formula and the implied volatility. What is an implied volatility? And then we will also look at the live example of the option valuation calculation, and I will walk you through how you can calculate or how you can put in the values in the model, which I will show you. And also you will be able to download the model if you need so, right? So these are the kind of things we'll be doing in the next set of videos, and hope you've enjoyed the video, and bye for now. Thanks for watching, guys.